Hi guys, Chris Ingram here with Prosperitas Financial. And today I want to talk about the difference between mutual funds and ETFs. ETFs, also known as exchange traded funds. A lot of people get confused on what the differences are, so I will explain that today. Mutual funds have been around for a very long time. ETFs are newer and fast gaining on mutual funds with their popularity. First thing to talk about is the assets you can purchase with each of them. So both of them are an ability to buy a diversified portfolio of investments. And you can buy stocks, bonds, gold, all kinds of different things in mutual funds and ETFs, and it's pretty much the same for each. So that is what makes them very similar. What makes them a little bit different is that the majority of mutual funds out there are what we call actively traded. Actively traded means that there's a portfolio manager who's buying and selling and trading within that account. ETFs tend to be what we call passively managed, or passive investments, not even managed. Passive investments means that your ETFs tend to be tracking to an index. So the S&P 500, very popular, well-known index, you can buy an ETF that is an S&P 500 ETF, and it is going to follow or track that ETF. But there's nobody actually managing the fund and buying and selling on a regular basis. With that, costs tend to be a little bit higher at the mutual fund level than they are at the ETF level. Part of that reason is what I was just talking about. You have a manager who is managing the mutual fund. Well, he needs to get paid, so there's some costs in there that helps him make some money for the active management that he's doing for that fund. Where the ETF, because it's passively managed and it doesn't have that management or that person that's managing the portfolio, there's no cost for that person, and therefore the costs tend to be a little bit less at the ETF level. Mutual funds can have also what's called a load or an upfront fee to purchase the mutual fund. ETFs can have what's called a commission or a trading cost. So you just want to know this doesn't always apply. So it's something you want to look into upfront and make sure you understand if there's any upfront cost to either the mutual fund or the ETF. The other thing to note is when they trade. So a mutual fund, you place an order to purchase a mutual fund, that mutual fund prices at the end of the trading day. So you can place it right now. It's 10 a.m. right now as I'm recording this video. Market's going to close at 1 o'clock. I place a trade for a mutual fund right now. It's not going to price until 1 o'clock today when the market closes. ETFs, on the other hand, you can buy and sell them throughout the trading day, just like individual stocks or other assets that are traded on the exchange. So if I place a trade in an ETF right now, it's going to price right now at the current price of that ETF. I could actually sell that ETF later today, so I could buy and sell in the same day with an ETF, where I could never do that within a mutual fund. The other thing is, with that trading comes the opportunity to place what's called limits or stop orders on your ETF. This is something you can't do with mutual funds. So I could say, hey, I want to buy this ETF, but I only want to buy it once it drops to a certain price. That limit order that I put in is going to sit there and wait for it to hit that certain price, and then it'll execute that order for me. I don't have that option with mutual funds. So you have a little bit more control over how you trade ETFs versus mutual funds. And tax efficiency. So mutual funds, because that guy or gal that's trading the fund is actively managing and buying and selling within the fund, they can generate some capital gains or taxes that you have to pay at the end of the year, where passively held ETFs don't have that active trading going on. So mutual funds tend to be a little less tax efficient because they have this opportunity to build up capital gains and tax liability, where ETFs, because of them being passively managed, you don't have that as bad, and so they tend to be a little bit more tax efficient than the mutual funds. And last thing to note is that if you're contributing to them on a regular basis, if every month you want to put money into them systematically, mutual funds tend tend to be the easier fund to use if you want to do systematic investing. ETFs are a little bit more difficult because they're traded on during the day, so it's harder to put in an automatic trade that happens in an ETF on a regular basis. That works much better with a mutual fund. So have some similarities, lots of differences. They're both great. It just depends on what you're looking to accomplish. So if you want to understand it a little bit better or know what works better for you, please give us a call. You can look us up at prosperitasfin.com.